In this video, I wanted to give you an idea of how it can affect your mortgage payments by paying extra, or you can add just a scheduled number of additional totally early payments as well. So often when you go get a mortgage, it will be 30 years or 15 years, and you may have different interest rates. Often the interest rate is lower if you get a 15-year mortgage than it is if you have a 30-year mortgage, although your payments may be greater. Suppose that you needed a loan for $100,000, so I have that filled in. This is really real life right now. The interest rate has dropped significantly. It's 2020 because of the pandemic. So 3.25 for a 30-year mortgage is reasonable. And you can see, so because 30 times 12 is 360, then the math is already over here on the right side for me. And it already has calculated my payment. So for a $100,000 loan at this interest rate for 30 years, my payment will be $435.21. You'll notice that it has already given me a schedule. So if I just stick with that exact payment every single month, $435.21, this is the amount that goes only towards the principal, and this is the amount that goes just towards the interest. So when you're paying on a house, more of the money that you're paying, most of the money that you're paying is going towards interest. And as you pay this down, so you'll notice over here on the right, I left the percentage that this person still owes on their house. So even after they've paid for, let's say 4 years, so 48 payments, 4 years, they still owe almost 92% on the house, because all of that money they're paying over and over again, most of it is going, they're paying the same amount every month, but most of that money goes towards the interest on that. So that's something I wanted you to keep in mind. And so when I keep saying pay over the required payment, please take that into consideration. I'm just going to stick $5 in here. If you could just afford $5 extra, that $435 payment, look at what happens. You cut out only 6 payments here. You cut out 6 payments, and also you'll notice your total interest went down. So it's $55,000 here, and we now have 354 payments, and because we'll be paying it off earlier since we added extra payments. Only $5, so keep that in mind. Let's put in $10, so maybe you're 15. Let's try 15. Suppose that you could afford $450 a month and 21 cents. So we're going to stick $15 in here. And all of a sudden, I'm almost 20 payments different here. $53,000 is now what I'm paying in interest. So I'm shortening that loan term, and I'm paying less in interest over time. Okay, let's throw in the big dollars. Let's say that you could afford $100 a month. So you're gonna not go out and eat as much, maybe not have Netflix, save that money and put it towards your house payment. Right now we're at 53. Let's put in $100. And we drop that to below 40,000. Not only that, but your actual payments here. So we're down to only 261. And if you think about that, 261 divided by 12, you're looking at 21 years instead of 30 years. So this is just to give you an idea. Why do I keep saying pay over the monthly payment? Even $5 affected your overall interest there and your number of payments. Maybe $5 you feel like that's not significant enough, and that's a valid argument as well. Since it's long term. However, it also would increase your credit score, and that is beneficial in the short term. And so that's another reason I want you to know that it's always worth it to pay over the required payment. I'm going to go back to what we had. So $0 here. This was what we had originally, that 56,000. And I'm going to show you what happens if you do a 15-year loan. So already you can see the interest drops significantly. Now your scheduled payment is nearly twice as much, but your interest drops significantly. But that's not the only benefit of having a 15-year loan. If you get a 15-year loan, often the interest rate is lower. So right now, if you get a 15-year loan, you could get a little bit lower than this. They're extremely low, 2.5. Some of my friends have refinanced for 2.5 lately, but let's just say 2.75. And you'll notice with that 30-year loan, we were paying over 50,000 and now we're paying only 22 in interest. Now, yes, you're paying more per month, but you're paying lower in interest. Now, this is all really important. I wanted you to know all of this. You pay this off much faster in a 15-year loan, and that interest is lower. So those are important things. However, sometimes I end up arguing with mathematicians about whether it's better to get a 15-year loan or a 30-year loan. And if you're just coming out of, say, graduate school, a 30-year loan may be in your best interest, because a 30-year loan, yes, you're going to have higher interest. I'm going to throw in 3.3 and a quarter here. And yes, it's a 30-year loan. So you are going to be paying more in total interest as long as you only pay the monthly payment. So what I'm suggesting is don't only pay the monthly payment, pay extra. I'm going to throw in $200 here. So suppose that you could afford this, and you can see that that can drop significantly. Suppose you could afford $200 for, oh, say the first couple of years right out of grad school, and then you get a nice paying job so that you can maybe even double this, 835. If you have a good job, you could afford that, and you can actually make a 30-year loan work out in your best interest. So that's actually kind of something that I wanted to bring up as well. So a 30-year loan or a 15-year loan, those are just a couple things that you didn't see in the homework, so I wanted you to have seen that. Thank you.